Okay, thank you for joining. Welcome to our webinar. I'll keep this tight. We've got about 15 to 20 minutes, and I want to make sure all of it is actually useful to you. My name is Seppe Van Hove. I'm the business development representative here at openthebox. And for those of you who don't know openthebox, we are a private market data platform for financial professionals with real-time data on more than 2 million Belgian companies. If you have any questions, feel free to drop them in the chat and our moderators will get to you. And if you don't get an answer today, expect one in the next few days via email. I want to start with a question, and I'd ask you to really think about it rather than answer it immediately. Take the last 5 deals you worked on and that didn't close. Not the one that got screened out in week 1, but the ones that made it through initial screening, went through rounds of diligence, and had a model built, and also had partners invested. Now ask yourself, what did those deals actually cost you? Let that sink in. Most deal teams can tell you their conversion rate, how many deals they looked at, how many deals they signed, but the cost per failed pursuit, broken down per stage, by type, by team, really almost no one has that number, and that gap is what this session is about. Let me make that argument directly. So when firms do post-mortems, they almost always focus on deals that closed badly. The overpriced acquisition, the sector that turned, the management team that didn't deliver, and those failures are visible, reportable, and also discussable. What really makes it into the debrief is a deal that almost closed, the one that consumed 6 months of partner time, 3 rounds of due diligence, 2 rounds of legal review, and a full financial model before quietly dying in the final stretch. And that deal that doesn't show up as a loss on any fund statement, but it costs more than most people are willing to calculate. The direct costs are well understood. You have legal fees, advisor fees, due diligence cost, management time. And for a mid-market transaction, you're typically looking at anywhere from 500,000 to several million euros. But the direct costs are actually the smaller part of the problem. And there are 4 layers here. The first one, the opportunity costs. Every week, your team is deep in diligence on a deal that won't close, is a week they're not advancing a deal that actually would. In a market where good targets are scarce and competition for the best assets is fierce, mislocated attention has a real price. The second one is relationship capital. Advisors remember which firms run clean processes, and sellers talk, of course. A firm that repeatedly walks away late at maximum costs and maximum disruption, this builds a reputation that makes future deal access harder to earn. The third one, team bandwidth and morale. So deal professionals who spend months on a process that collapses don't just lose time, they also lose momentum. And that's harder to put a number on, but anyone who's been through it, yeah, knows what it does to a team. And the fourth one, dry power pressure. So for private equity firms specifically, if you're sitting on uninvested capital, and every failed pursuit delays deployment, you're adding pressure to the back end of the fund cycle. And the clock doesn't pause while the process unravels, of course. The near miss is not a near win, of course. It is a full loss with a longer run up. The real number when you account for all of this is rarely calculated, and almost never reported. And that invisibility is part of the problem, because if you're not measuring it, you're not managing it. And so why does this keep happening? It's not careless. The people running these processes are experienced professionals. The answer is mostly structural, and once you see it, it's hard to unsee. And here's the pattern. So the further a deal progresses, the harder it becomes to make a rational go or no-go decision. Partners who have spent months on a process are not neutral evaluators by that point. They're actually advocates. So the IC decks exist. The model has been refined. The relationship with the seller has been built. And at that stage, the pressure to close is enormous, of course, and the pressure to walk away requires real conviction. And red flags that surfaced in month 2 get rationalized by month 5, and issues that would have been killed the deal at screening get reframed as manageable. And when firms do finally walk away, they do so at maximum cost, with the most time and also the most money, and also the most relationship damage. And this is not a people problem, this is a process problem. The deals that collapse at the 90% mark weren't killed by bad luck. In most cases, they were killed by problems that were visible far earlier, but that's the process wasn't designed to surface. The most under-designed part of the sourcing workflow across most P and M&A firms is a period between initial identification and LOI, the pre-LOI qualification layer. It's where the most consequential decisions get made with the least rigorous structure. The cost of waiting, so a deal screened out in week 1 costs almost nothing. The same deal pursued for 6 months costs hundreds of hours and millions in fees. And the difference is not the deal, it's the decision to pursue. And when that decision was made, and on what basis, qualifying better at the front end. So the firms that outperform on deal economics are not the ones that execute better at the back end. They're the ones that qualify better at the front end. And that means asking harder questions earlier, and 4 of them specifically. The first one is about financial trajectory. So is the target's financial picture actually what it appears to be? Not just the headline number, the shape of it. A company showing flat EBITDA over 3 years tells a very different story than one showing the same number after sharp decline. The shape of the data matters as much as the data points. The second question is about the people layer. So who are the real decision makers, and what do they actually want? A founder who wants a clean exit behaves entirely differently in a process than one managing a complex family situation or a distressed shareholder structure. And understanding that in week 1 versus week 12 is a huge difference, of course. The third one is about ownership and group structure. What does the structure actually look like once you map it? So subsidiaries, holding entities, cross ownership, beneficial ownership layer. A target that looks straightforward on the surface can carry significant structural risk, and structural complexity drives legal cost and timeline risks, both of which can kill a deal that looked fine at the outset. The fourth question is about early warning signals. Are there already regulatory or reputational or litigation risks visible? These are not static data points, they shift during a process. A target that looked clean at initial screening can deteriorate significantly over a 6-month diligence timeline. And every deal team asks some version of these questions. The problem is not the questions, it's when they get asked too late, too superficially, and with too little data to answer them reliably. And then this is exactly what we wanted to address with Open the Box. And I want to show you very quickly how a deal team can surface the information that typically only appears much later in a traditional process. And I mean then in minutes and not weeks. I'll share my screen. Should be seeing my screen. This is our platform, Open the Box. What we see here is an overview of the most important financials. We see the financial ratios who are fully created in here. Also, it's historical data. I think we can go back more than 15 years in time. We also offer our new tool, the cash flow statement, and we can see so revenue, EBITDA, and critically how cash flow compares to EBITDA. The gap is where a lot of the real risks lives. A business that looks healthy on EBITDA but tells a very different story on cash conversion is signaling something. That's something usually only surfaces at full diligence, and if you get that far, here it takes about, I don't know, 30 seconds to check this. Then there's something else I really want to show you. That's our spider web, our most famous feature. Here you can see the ownership and group structure, who actually owns this business. Is there a holding structure, cross-holding subsidiaries, family layers? And it's this this complexity that drives legal costs, and that's something that sometimes takes weeks, but here it also takes a few minutes or even 1 minute. And you can just play around with it. You can see after, for example, here you can see, okay, what is he also doing? You get a full list. We can undo it here. Yeah, you can just play around with it, with everything. Same with participations. You see everything. You can just easily expand it, as you can see here. Another thing I want to show you is also something about our financials. It's our financials are also compared to its peers. What do I mean with this? So we see equity and operating income. Those are compared to companies with the same NASI code. It's always very nice to see a good overview of what a company does compared to its peers. Same with indicative valuation. You can just see it over time here. Something else I want to show you is our advanced search tool. So it's a tool you can filter easily on all NASI codes. You can just click on one, and then you can combine it with a lot of filters. One of them is, for example, the financials. If you're searching for companies with an EBIT that's, for example, more than 100,000 euros, then you can easily see it here. I think this is all for the demo. We can go back to the presentation now. So now my screen should be reshared. What this represents is the ability to move the most critical qualification checks to the very beginning of the process, before you've committed partner time, before you've engaged advisors, and before you've had any conversion with the seller that's hard to walk back. The goal is not to kill more deals, it's to kill the right deals at the right time. So the ones that advance are the ones that are worth advancing. Then there's one final question. The question isn't why did this deal fail? It's at what point did we know enough to stop, and why didn't we? I'll leave you with one metric we're tracking. So most private equity and M&A firms track deal conversion rate. What they rarely track is the cost per advanced deal that didn't close, broken down by stage. And that number reveals not just the deals that failed, but where in the process the screening broke down. A firm that consistently loses deals at the LOI stage has a different problem than one that loses them at the final diligence. Both are expensive, and neither is bad luck. So we would suggest to do this for 1 quarter. So if you track that number for 1 quarter by listing every deal that didn't close after screening, assigning it a stage, estimating the cost, and finding an average, you'll have a clearer view of where your pipeline is leaking than any conversion metric will give you. And it will surprise you. So if you have any questions, don't hesitate to book a demo or send us an email. All links are in the chat. Thanks a lot for your time. I hope this was useful, and I'll hope to see you soon. Thank you. Bye bye.